Bank of Canada cutting rates again, no real surprise there. Let's get more from a guy who follows interest rates closely, Christopher Wein, Chief Operating Officer at Equiton Developments, a big builder of apartments and condos, and also Beata Caranci, Chief Economist and Senior Vice President at TD Bank Group. Thanks to both of you for joining us. Really appreciate it. Could I start off with you, please, Beata? Was there anything in the Bank of Canada's language that's jumped out for you? Any surprises?
Not really. You know, they continue to use very cautious language. They made the point that none of their forecasts currently reflect tariff impacts on the U.S. Of course, we had all expected that they will react in real time as information is known. They did provide a lot of scenario analysis on the different pathways and the complexities in which tariffs hit the Canadian economy, but would not answer which way they would move necessarily with interest rates due to the complexity of the shock that they would have to monitor in real time. So overall, they did the quarter point cut, very status quo on the forecast, some tweaks here and there, but nothing really of a surprise.
Our Bloomberg colleagues reckon that the language from the Bank of Canada suggests that the bank isn't likely to do more cuts to monetary policy, more to rates, until we know more about Trump's tariff policies. Would you agree with that, Beata?
Well, if you look at the market reaction, there's only about a 50% cut priced in for their March meeting, which basically confirms that everybody's sitting on the fence. Let's wait for greater clarity to move the odds in one direction or the other. So nobody's taking a conviction call right now that, you know, this is absolutely going to happen or not. There's just too much uncertainty. So I think that's a fair assessment. Christopher,
you obviously, interest rates are central to your business, real estate. You think that getting to a 3% level is an important psychological benchmark, possibly for consumers?
I do. I think it really helps with consumer confidence. I think that home buyers have been sitting on the sidelines waiting for getting us to 3. I think 2.75 will be even a better psychological barrier, but I think starting the year out at 3% really signals that it's time to get back into the market. And if you look at the stats that, home sales across the country in November and December were up year over year. So even the rate cuts that occurred through the fall is starting to bring things back.
And that's a big determinant, a big factor for buyers, the rate, the cost of borrowing.
Absolutely, yes. It's a big factor for buyers. It's also a big factor for us in the development industry.
Yeah.
Because we borrow a lot of money, and the cost of money, we have to pass that on to the home buying public. So the cheaper it is for us to build, the cheaper it is for us to borrow, the better it is for housing affordability, and then that gets passed on to the consumer. They can get better mortgages. Now that the government increased the CMHC to $1.5 million for insurance, was fantastic. Now we just need to get rid of the GST.
Oh, so the GST on...
We should have a GST holiday on new home purchases up to $1.5 million. We really need that. We need to, in order to create affordability for people to get into the market, first-time buyers, then we shouldn't be taxing houses for first-time buyers.
They've taken the GST off rental?
They have, but they haven't done it for new homes.
For new homes, thanks.
Correct.
Beata, what is your feeling? How, now, of course, we've heard real estate, or too much of our economy is devoted to real estate. Christopher may have thoughts on that, but in any case, we do have a very real estate heavy economy. So presumably rate cuts will spur some kind of a revival in that sector.
Oh, you bet. And as mentioned, it is one of the most responsive areas to interest rates. So on the one hand, the way the mortgage market is structured, we react quickly when mortgage rates go up in terms of it becomes a greater burden to households relatively quickly, more so than what you see in the U.S. Likewise, when rates go down, we benefit faster from those rate drops in terms of reducing the debt burden and the debt service costs and allowing for that entry point into the market. So that is Canada's DNA when it comes to housing. It is very substantial as a share of our economy relative to what you see in the U.S. and even in Europe, about 2 times the share of the economy. In this particular case, when you're getting threats on the export market and those threats being a disincentive to invest domestically, you have to rely on your domestic drivers, which go back to the consumer and housing. So in this particular case, the timing of the recovery of the housing market and consumer spending, by the way, being quite strong, both in the third quarter and in the fourth quarter, ending the year looking like it's going to be about 3% growth. This is good timing to help push against some of the negative influences. So I don't think the Bank of Canada would criticize the size of the housing market at this juncture.
Right. Beata, before we're tight for time, just give us your thoughts on the US Fed, widely expected to stand pat. What are you looking for to hear from Jay Powell this afternoon?
Yeah, so they have a situation where their inflation is just getting stickier and stickier. Their economy remains quite solid, and they're not seeing the downward influence on inflation as much as you've seen here in Canada. Even though they have a very strong dollar, it's not imparting a big downdraft on prices. So at the end of the day, they are no rush. They have an economy that is tickety-boo. It's just continuing along at a steady growth rate. Inflation is not ideally where they would like it to be. It's not as hot as it used to be, but it's definitely not getting anchored to their 2%. The good news is that their inflation expectations are anchored. And so they would be concerned if both the numbers were high and expectations, but that's not the case. They have anchored inflation expectations. So they can afford to wait and see how things transpire. They're in no rush. I think the markets think maybe at most this year we're going to get 2 cuts out of the Federal Reserve. Again, also an economy that's going to have to see how tariffs transmit into their end prices. So they're also going to be in a wait and see mode.
Chris, before we go, this is a theme you've sounded before, that you feel the housing policy should be directed to the people who actually live in homes.
Yes.
And all tenants or purchasers, and not short-term investors or speculators.
Yes, no, absolutely. I think that one of the challenges we've had, especially in hot markets like the GTA in the past, is we had so much speculation that we weren't catering to the actual, upward mobility of Canadians and young Canadians. And what we need for public policy is we need at all levels of government to make new housing cheaper, more affordable, and we really need to encourage that it's easier for people to buy homes, it's easier for people to mortgage homes, and we want home ownership in Canada. As Beata said, it drives our economy.
Or rent homes. It's not.
Absolutely.
Yeah.
No, we're big proponents of rent. We own a lot of rental properties across the country. And again, the governments have started to make moves to make rental more affordable and to make new rental easier to finance as far as building new rental.
I think we'll have to leave it there. Thank you very much indeed, guys. That's Beata Caranci, Chief Economist and Senior VP at TD Bank Group. Beata, thank you very much indeed for joining us. And our other guest,